Welcome to Gateway Crossing. My name is Chad Schieler, founder and principal of Focus Capital. I'm very excited with this today. I'm going to go through the Gateway Crossing opportunity that's open to accredited investors only, walk through the deck, walk through the business plan, the market, why we love this deal, and what it means for you as an investor. So at that point in time, you can follow along in your slide deck in your email if you'd like to. But I hope to give you more of a personal take on this opportunity and more than you can find in just the deck, more on the backstory and how we got this deal at such a great price. So here we go. So quick disclaimer for you guys. Obviously, no investment returns can be guaranteed or promised, and this is open to accredited investors only per the SEC. Quick high level for you on the deal. So if you're if you want the short version of this opportunity, say watch the first 5 minutes. If you want the whole version, watch the whole video. So we're raising between $6.5 and $6.6 million in this offering. This property was built in 2021. 160 unit property located in Clarksville, Indiana, which is only 5 minutes north of Louisville, Kentucky. It's in the Louisville MSA still. And this property is very unique because it's located just 10 minutes from our sister property we bought back in May, Heritage Square. For an investor, how it works for you is we're projecting to give you a 15% return on your money, if not more, a 7.5% average cash on cash return, and a total return equity multiple in your money of between a 2.0 and a 2.44 equity multiple over a 5 to 7 year hold period. We're assuming debt at 3.5% fixed, which is incredible in this market, and the minimum investment is $100,000. One of the best reasons we love this property is really just the going in price. And in real estate, you make your money on the buy typically. And if you buy it right, a lot more can go wrong and still come out on top. And I think this has a little more of a story to it, kind of like Heritage Square did. So I want to kind of review that to you now. But we're buying this property at a $23 million price point, which is $143,000 per unit. Cost of build could be upwards of $180K per door typically for hard costs. So the story really is because we already bought Heritage Square from this developer, this seller, and we went through on that with no problems at all. When we closed on time, he was more concerned about terms on this property and closing on time than the highest price. We weren't the highest price at all. There were other groups that actually offered way more than we did, some close to $25 million. But was more important to him to have a reliable buyer in place that he knew would close on time, that could raise the capital. And for us, it makes sense. We already own Heritage Square. They're only 10 minutes apart. We love the layout. We love how he built the properties very efficiently. So, we negotiated pretty hard in this deal, but he took our offer on what we were willing to pay for it. And now we have an awesome one to show for you guys, to investors. So overall, the returns, like I said, great cash flow, great tax benefits, which we'll get into a little bit later here. Great IRR, great multiple on your money. But the Louisville MSA is one of our favorites because it's really done well with rent growth in the last couple of years, especially the Southern Indiana market. And Louisville has actually averaged 3.5% rent growth in the last 2 years, with this year on pace to be over 4%. The national average is only 1%. So it's one of the shiners here in the nation with rent growth. Economies of scale. This is one of the reasons we love this deal, is because now I have over 340 units in one area, just 10 minutes apart, to where we can share management. We can share payroll, some maintenance techs, to both properties, because each property isn't quite large enough to have 2 maintenance techs full time. They're a little below that 200 unit mark. But now we can really optimize the management and share the payroll, and which will benefit Heritage Square as well as Gateway Crossing. And lastly, we love this because of the tax of the financing terms with the assumable debt. We're going to assume a loan of 3.53% fixed for the next 7 years, and we're going to couple that on with one more loan, still with Fannie Mae for 7 years. That should bring us to a blended average of rate of 4.1 to 4.2% on this opportunity. I think it's always very important to walk through a sensitivity analysis to kind of see what happens if this does not go well, or what happens if you can't get the sales price in year 5 is something like you think you're going to get. Well, we ran through a scenario here to where we believe, first of all, our exit cap rate is pretty conservative at a 6 cap, and that's what we're planning our numbers based upon. But we've ran through some scenarios to where, let's say it's only a 6.25 cap we can sell it for. As you see here, the IRR only drops down to 13.95%, which tells us that not a lot of these returns are based upon the exit sales price. A small portion of these are. And of course, there's a chance to hit a triple and a home run and beyond, but we aim for doubles. We don't go for home runs every time. We look for conservative doubles that we can underwrite well, and we can build in some conservative layers here and just earn great markets and then do our business plan. So for you as an investor, probably the biggest question I get is, how do I get paid? Like, when do I get paid? How do I get paid? So I'm going to walk you through a sample investment return and walk you through each year we've laid out here in the bottom right on what a $100,000 investment means to be in this deal. So obviously you'll be a part membership interest in this opportunity on the actual entity. You'll get a K1 every year. You'll have tax benefits and the cash flow. And here's how it plays out. So these are projections, right? And we're going to plan that year one be about $5,400 in cash flow the first year. And year two goes up, so $6,688. Year three, $7,692. Just estimates, by the way. And then year four, and it keeps going from there. And what this means for you is, like, you'll be getting quarterly distribution checks from the entity for Focus Capital. We'll distribute those along with monthly email updates. And then really the big payout comes at year 5 to 7 when we sell the property. And that will be the appreciation and the gain from the sale. So you'll probably get about a third or so of your overall return from the cash flows along the way each year. And then the rest will come when we sell the property someday. So in this scenario here, you'll put $100,000 example in this investment opportunity. And by year 5 to 7 we sell, you would have got a total return, including your upfront capital, of $237,496 in total proceeds, which is a return of $137,000 on the initial investment. So I hope that explains more about how you get paid there. We will be moving to monthly distributions very soon, but for right now it will be quarterly, and those start within the first 3 months of property ownership. All right, let's go over the property itself. So Gateway Crossing is mostly 2 beds, some 1 beds, and it's got some very large townhomes at the property as well, which are very nice. Aside from that, great community center, great fitness center, and the bathrooms are great. And this property has great finishes. So it actually has solid surface countertops, great stainless steel appliances, great fixtures, LVP flooring, and tenants are very pleased with the property. I'm going to go over next kind of what our plan is in the property, how we're going to improve the value and improve the resident satisfaction. So here we go. So our strategy really is simple. There aren't renovations here to be done. There's not a lot of turnover or large improvements, but we are going to add some amenities to give the tenants more value, to increase the value of the property and increase the opportunity to raise the rents eventually. So we're going to add a playground for the families that have kids, and we're actually going to shorten the dog park. It's actually too large right now, but it'll give us room for the playground. And we're going to add a grilling area with a pergola, so we can create more community feel of the property, which will increase our satisfaction and long-term retention. That's the goal there. Aside from that, we have some strategies here to increase the revenue of the property. One is simply to build back the right amount of water and sewer to the residents. As of right now, the current owner is not building back the right amount of water and sewer, so he's stuck paying for part of that when the residents should be paying for almost all the water and sewer charges. And lastly, which is the biggest part of this, is we're going to be creating an bulk internet package, which will create more revenue share for the property, as well as give the tenants a higher data speed on their internet package for their units as well. Going more into the market. So Louisville MSA, again, why we love this market is because of the rent growth. They've seen great population and job growth the last few years. This year they're on track to be over 4%, compared to the national average of only 1%. And really it's driven by just limited supply in the market. We've seen massive slowdowns in new development starts, whether it's due to tariffs or construction costs or labor costs or cost of debt. Developers can't build deals like they were able to, a few years ago. And then we're seeing very strong job creation. We're seeing the River Edge Commerce Center a few miles away, creating over 18,000 jobs in the area, with 12,000 in place right now and 6,000 still to go. So we believe that all these forces are colliding here to create a lot more demand for the current properties even built. And when you buy a property at a low basis, a lot more can go wrong to just break even. So we love this opportunity because of these reasons alone. And this graphic kind of shows you the starts that we've had for multifamily over the last 10 years and how they've declined here now in the recent last few months. Economic strengths is some great employers here. Great employers like Amazon, GE, Samtech, Ford, Bose, like great employers here. And as you can see in the bottom right here, Clarksville, Indiana, Gateway Crossing is just over the river, about 5 miles away from downtown Louisville. So it's a very, very short commute. Excuse me, very short commute for residents that want to work downtown Louisville and then drive back home. It's a 5-minute drive because Indiana is a lot more affordable than Kentucky. Indiana has lower property taxes, overall lower cost of living. It's just a better location, which is why we invest here in Indiana for these residents as well. And then Clarksville, Indiana, here's a great map for you to look at. It kind of shows you where each one of these different things are. There are some high schools and middle schools just down the street from the property. We have some great employers nearby. We have the River Edge Commerce Center over here to the southeast. Then here's the river. So you can actually see the towers downtown Louisville off the interstate. You're getting off here from the highway. It's pretty cool. So it's very close proximity to downtown Louisville. The next page here, I won't go through all these different comps on the video, but you can look at these if you want to. But the main point here is like on the bulk of our units, which are 1 beds and 2 beds, we aren't even at the average across the comps, comparable properties. So we feel like we have a lot of room we can grow and actually do better than the business plan here. But we feel it's a very healthy place to be in and a great place to be in for our investors. And here's a map as well. So we got all the comps are pretty nearby here to Clarksville, Indiana. And then here's Heritage Square. In case you weren't an investor on this property, I can walk you through a couple high-level details. But again, why we love this deal with Gateway Crossing is economies of scale with both assets. They're only 10 minutes apart from each other, and we'll be able to share management, share maintenance techs across both sites to help them both grow together. But this property here was acquired back in May at $146,000 per unit. We're acquiring Gateway Crossing at $143,000 per unit, and both were the very similar in-place cap rates upon sale. The only difference main difference being the assumable debt with Gateway Crossing. And like I said, we already have the same management company in place at Heritage Square that will be managing Gateway Crossing, and they're already managing that property today. So it'll be a very, very seamless transfer. There won't be transfer at all, actually, just transfer of ownership, but a very seamless transition into us acquiring Gateway Crossing officially here in September. A couple things here on this page, if you want to review these yourself. I think the most important thing I see here is the tax advantages. Back on July 5th this year, Congress passed a bill that now pretty much doubles the tax benefit that you get the first year of real estate ownership or investment. So what this does is we're estimating on a $100,000 investment that you put in this deal, $80,000 would be the depreciation deduction year one. That's a paper loss year one on your K1. Again, consult your CPA for any kind of tax advice, but check to see if you can use that yourself on other sources of income or other gains. But that obviously can be used to offset the cash flow you receive. And if you don't use it all in that first year, it can be carried forward to future years. So this kind of shows you the source and uses of our different costs involved in the project, the loan, the equity, shows you some of our annual operating costs that are estimates here. For example, shows you some of our fees that are involved in the deal, which are very standard. Shows you the loan information. We have 7 years left remaining at a fixed rate loan at 3.53%. And we'll do a second small loan at probably 6 to 6.25% interest rate, fixed as well. A weighted average being around 4.15% for the next 7 years. It is non-recourse debt. Overall loan to value be around 70% on this asset. Okay, so here's the pro forma, and again, I won't go through all these numbers here on this video right now for you, but I want to point out a couple things. Number one thing is our rent growth factor. We're estimating a 3% per year on average rent growth over the next 7 years, and that's important because we could have put it at 4% this year. We chose to not do that just because we want to be conservative here and allow for some room to outperform if we're able to. Of course, other income growth 3%. We have a vacancy factor at 7% for years 1 to 4, being extra conservative there. Years 5 to 7 would be a 5% vacancy factor. So take your time and look at that if you want to, or call their team to get more information on that as well. More on the team. So Focus Capital, we have a great mission here. We want to impact over 1,000 families with real estate investing and 1,000 of residents with financial literacy courses. And you got me, the founder, obviously. You have Chad Olson, and then Chris Brown, asset manager, and then Tracy, our assistant. We're adding more to the team here pretty soon as well. So our overview, give you a quick overview on what we currently own right now and what we've sold so far. So we have exited 4 of my first deals. These resulted in an average IRR of 44.18%, and these are CPA third-party verified, in case you wondered about that. But we do have 7 other projects currently in place right now that we're working on. Most are value add. One is a development deal. So the next page here, we'll kind of go through the next steps. So step 1 is to register investment online. We've got a quick link in the email to go through. It's very simple on our online cash flow portal. The next step is to sign the documents and fund your investment. You can do either ACH or a wire. And then from that point, you let us do all the work as Focus Capital. We manage a deal, give you updates every month, and distribute once a quarter starting Q4 of this year or Q1 of 26. Pretty much we'll want to have 2 months of full months of operations to then distribute capital to our investors. Like I said, email updates every month, K1s every year by March 15th. We always aim to be transparent and have open communication. You'll be able to reach me as well as my team if you have any questions at all going forward. And then as far as the timeline goes, I would encourage you to register today, or if you call our team after that point in time, we have our call. The latest date for funding due is August 31st or whenever we fill up. Here to Square was a higher raise than Gateway Crossing is. It was about $4 million more. So there's a possibility we could end up getting full before our closing date or before our funding date on Gateway Crossing. And then of course we're going to plan for between a 5 to 7 year hold period on this asset. Like I said, how to invest, we can click the link here in the deck that you have. You can book a call here at this link here. At the end of the deck here, they've got we have a bunch of frequently asked questions that most investors ask us from time to time, and these may be helpful to look at to get some of your first questions answered. But again, if you have questions at all, just let us know. Thank you so much for taking time today to listen to this video and hear more about Gateway Crossing and our business plan. I will be investing my personal capital in this deal, and I invite you to do as well. Thank you so much.